Hello and welcome to Unacademy IAS, a one-stop destination for all the English medium civil services aspirants. Welcome to another session of economy this week, wherein we will be taking up the important economy related articles from different newspapers and analyzing these particular articles to address the questions not only for the prelims examination but also in the mains examination. In today's video, I'll be covering the articles from 2nd to 8th October 2025, and this is the list of the articles. The coverage has been comprehensive from different newspapers in order to ensure that all of your requirements will be met in this particular video alone for Indian economic current affairs. If you're liking this initiative, do not forget to hit the like button, and if you're yet to join our YouTube channel, kindly do it right now. Let me start the discussion. First article is related to Supreme Court of India accepting a petition which is questioning the constitutional validity of securities transaction tax, or in short STT. Now let me start with the basics here. The government of India back in the year 2004, when Mr. P. Chidambaram was the finance minister, in the Finance Act introduced the concept and implemented the concept of securities transaction tax. Now, what is this securities transaction tax? When they talk about securities transaction tax, essentially they are focusing on the securities in the equity market. Please remember this. It is focused on securities in the equity market. That is, whenever I buy or sell, that is, the trading of these particular securities will attract a certain tax called as securities transaction tax. Now, what is the rate? It will vary from one type of security to another type. In futures, option, as well as the stock market, you don't have to remember all the rates. Just remember, trading will attract a tax that is called as securities transaction tax. Now, what was the logic? Why did Government of India implement this particular securities transaction tax? The government was worried about tax evasion. That is, the investors who will earn profits, who will make money by buying and selling the securities in the market, will not disclose this particular source of information. And because they are not disclosing, the government will not be able to impose and collect taxes on these sources of income. In order to address this particular issue of tax evasion, government implemented securities transaction tax. But now, Supreme Court of India has accepted a petition questioning the constitutional validity of the security transaction tax itself. And the petitioner makes it very clear. The request to the Supreme Court of India to look into the STT is not because it is a tax. No, not because it is imposed in the stock market. No, because it is violative of the constitutional provision. What are the contentions of the petitioner here? Listen to me very carefully. First one, it violates the principle of double taxation. It violates the principle of double taxation. Right? What is a double taxation here? Imagine I generate certain amount of income. On the same income, if the government will impose taxes twice and collect taxes twice, that is called as double taxation. In case of securities, when I trade them, let's say I purchase these particular securities, I will pay certain amount of tax. And I will sell them, I will generate certain amount of revenue, I'll earn certain profits. On the profits, again, I'll pay certain amount of tax. So the contention here is the government essentially is imposing a tax. That is, when I basically sell it, there is a tax that I pay. And on the profits that I generate, again, there's a tax that I'll pay to the government. So on the same amount, the government is basically imposing taxes twice. This will lead to double taxation. Hence, it should be struck down. Second argument is, in case of India, the retail investor participation in the market is very less. A large number of retail investors are more interested in the equity market. Very less participation is there in the debt market. Now, by imposing these kind of security transaction tax, the government is imposing hurdles for more participation of retail investors in the equity market. And moreover, the argument of the petitioner is this is violating the fundamental rights which are given to me by the Constitution of India, right, for conducting a trade. for performing a profession, etc. So this is violative of the constitutional provision. And the third contention or the third issue raised by the petitioner is, when I incur a loss, in case of trading, if I incur a loss, even then I'm supposed to pay securities transaction tax. What is the logic in this? Worldwide, the practice is, if I make profits, if I earn money on that, the tax is imposed and collected. Fair enough, because the government also requires certain resources. But in the context of STT, despite me earning losses, the government imposes STT and collects it from me. Hence, this is not basically no correct as per the constitution. The Supreme Court should strike the taxes down. This is the contention raised by the taxpayer or the investor. In this particular case, the petition has been accepted by the Supreme Court. You will have to wait and see what will be the arguments put forward by the government, and finally what will be the judgment issued by the Supreme Court. We will follow this particular case as and when the discussion will happen in the newspaper. Now, before I go forward, I know a lot of you are preparing for the Civil Services Examination 2026. Now, listen to me. Of all the three stages, the most difficult phase for you will be the mains examination. Reason being, you are supposed to understand all these concepts. You are supposed to structure the answer correctly. You are supposed to write within the word limit, and you are also supposed to have very good reading material. Now, if you enroll into our courses, which are sold or which are available at a price of 19,999 now, if you use the code IAS English, you will not only get an extension of up to 12 months free of cost, you will also get access to our new program Nishchay 2026. The Nishchay 2026 is a program that has been created in order to basically cater to the UPSC Mains 2026. In this particular program, you will get access to the classes where the educators will be discussing the mains related topics. You will get access to the mock test. Your papers will also be evaluated, and assistance will also be provided as to how to structure the answer, where is the deficit in your answer writing, etc. Those who are interested, do check out the details if you're interested to enroll into our program. Let me go forward. Based on the discussion I've had regarding the securities transaction tax, let's solve an MCQ. Those who want to solve it, please pause the video, solve the question. Those who do not want to solve, listen to the discussion, no need to pause. Consider the following statements regarding STT. It is a type of an indirect tax. Please listen to me carefully. The STT is not an indirect tax, rather it is a direct tax. What is essentially the difference? In direct taxes, the tax burden cannot be shifted. The government will impose a tax, that is a security transaction tax, on the trader. So the trader will have to bear the burden of the tax, just like income taxes. Whereas in case of indirect taxes, best example, GST, goods and services tax, the tax burden can be shifted. The government will impose GST on a manufacturer. The manufacturer will shift the tax burden to the consumer. So the STT is a type of a direct tax in India. Second, it is applicable on equity and debt instrument. This is incorrect. It is applicable on equity, not applicable on debt instruments. This is waived off in case of capital losses. This is also incorrect. Even if you incur losses, that is you buy at a higher price, sell it at a lesser price, the government will not waive off the STT. No, you will have to pay the STT. All the three statements are incorrect. Right option for the question will be option D, none of the above. Let me go forward to the next article here. The bank consolidation may resume by the end of the financial year. Now, what are the important points? Listen to me carefully. The government of India has very recently announced that they want the public sector banks listed in the top 100 banks globally. The top 100 banks globally. And when I say top 100 banks here, please understand it is in the context of the asset sizes. Right now, how many of the Indian banks are listed in the top 100 globally? Only two of the Indian banks. One is the State Bank of India and the second one is the HDFC. These are the two banks which have been listed out of the total or top 100 global banks in terms of asset sizes. The government of India wants to consolidate the PSBs. They want to merge these particular PSBs, create a larger bank which will become competitive and will become part of the top 100 global banks in the future. This is point number one. Point number two, there is also a public sector enterprises policy. Please understand. The point number two, there is also policy implemented by the government from 2021, famously known as Public Sector Enterprises Policy. Under this public sector enterprises policy, the government of India has divided the industries, or let's say the sectors, into two groups. One is the strategic sector, second one is the non-strategic sector. What is essentially the difference here? The strategic sectors are those which are required for the government of India to achieve certain objectives. For example, national security, social welfare, etc. And these particular sectors are classified as strategic. And once you're classified as strategic, the government basically says it will have bare minimum presence. It will have bare minimum presence. What do you mean by bare minimum presence? Multiple companies which are owned by the government of India might be present in these particular sectors. The government wants to reduce the number of companies which are present here owned by the government. I'll take one example here. Out of these particular sectors, one of the areas, one of the industry that is covered is banking. There was a point of time where there were more than 20 public sector banks in India. More than 20. The government of India, over a period of time, has conducted a consolidation directive or consolidation process, wherein multiple smaller PSBs have been merged with larger PSBs to create a much larger bank. And what is the logic behind consolidation of the PSBs here? Once you create a large bank, this particular large bank will help in lending to infrastructure because the infrastructure requires large value loans for longer duration. It will also help in pooling resources, financial, human, technological, etc. It will also help in efficient utilization of the assets. It will help these entities become competitive with the global banks, etc. So, Government of India has already conducted multiple rounds of consolidation, reduce the number of PSBs. Right now, we have 12 PSBs in India. The government now is saying that by the end of this particular financial year, we will further go for consolidation, wherein we will merge the PSBs, create much more larger PSBs, which will become competitive. They might end up listing in the top 100 global banks. This is a very important point. Please remember this. Now, some of you would be thinking, sir, what is this non-strategic sector? All those areas where the government of India doesn't want to be present, doesn't deem it to be important for national security, etc., will be classified as non-strategic. In non-strategic, government will not have any kind of ownership of companies. Whereas in case of strategic, bare minimum presence. How will the government achieve that? By consolidation, by selling it off, if not possible, by closing them. Right? So, Government of India has announced this particular policy. And regarding the disinvestment, please remember the nodal authority or the nodal department associated with the disinvestment in India is DIPAM, Department of Investment and Public Asset Management. DIPAM. Please remember this. So, these are certain very important points associated with this announcement of Government of India. Now, based on this, let's solve an MCQ. Consider the following statements. DEA, Department of Economic Affairs, is the nodal authority for disinvestment in India. Incorrect. Why? It is not the DEA. In fact, it is DIPAM. I've told you this already. It is DIPAM. Now, what is the role of DEA then? Is there any relevance or the importance which you need to remember in the civil services examination? The Department of Economic Affairs is responsible for budget in India. Please remember the union budget. In fact, under the DEA, it is the budget division which is responsible for preparation of the union budget. Second statement, as per the Public Sector Enterprise 2021 policy, the government is aiming to have no presence in the public sector and privatize completely. This would be incorrect because understand, I am again saying this. Government doesn't want to completely privatize. Government wants to have bare minimum presence. The banking sector is classified under the strategic in the 2021 policy. Absolutely true. The third statement is correct. Listen to my advice here. I would advise that you memorize this particular picture. Please memorize this particular picture, can be useful in the prelims as well as mains in the answer writing. Now, based on the discussion, two of the statements are incorrect, only one is correct. Right option for the question will be option A. Let me go forward now. The banks to clear checks on the same day from today. And what is from today here? 4th October 2025. Now, what is this concept? Let me make you understand this. Listen to me carefully. Earlier, whenever there was a check issued, we used to follow a different process. And from the year 2008, RBI introduced a system by the name of Cheque Truncation system. And this particular check truncation system reduced the time period that was taken to clear the check. But even today, that is before the 4th of October, the time taken to clear the check was 2 days. RBI wants to further reduce it. That is on the same day the check settlement should happen. Now, what is the importance of this? Let me explain. Listen to me very carefully. Imagine I have an account in State Bank of India. I will issue a check to you. You have an account in Punjab National Bank. You will take the check. Let's say it is a cross check. Cross to check means on the left side corner, right, you will see two lines like this. The curved lines like this. In a corner, straight lines like this. This basically means once the crossing is done or it is a pay check, the amount will not be given in your hand. Rather, the amount will be transferred into your account. That is called as account pay checks. Now listen to me carefully. I've issued a check, account pay check to you. You have an account in PNB. I have an account in SBI. Now what you will do is you will deposit the check in the branch of PNB. Now the PNB branch, all the branches will collect these right into a house called as clearing house. From the clearing house, all these checks physically will be taken to Reserve Bank of India's office, where all the banks will meet, exchange the checks and also exchange the amount. That is, let's say SBI has to pay the money to the PNB in this example. The money will be transferred into PNB. Your account will receive the money now. For this to happen earlier, because the checks were moved physically, the time consumption was higher. So what did RBI do? RBI back in the year 2008 as a pilot project introduced a check truncation system. And a check truncation system, once you deposit the check in the PNB branch, instead of sending the physical check, now the digital copy of the check was sent. That is, the checks were scanned and the digital copy of this scanned check would be sent. Instead of physical movement, now digitally the copies would be sent. This would reduce the time and the clearing of the amount, settlement of the account used to happen much faster, comparatively much faster. But the problem with the CTS system, which has been in force till now, is that the checks are cleared in batches. The clearing happens in batches, and RBI is of the opinion that when you clear these checks in batches, the time consumption is again higher. We are using the digital systems today, the digital payment methods such as UPI, IMPS, RTGS, etc., where the time consumption is much lower. So what has RBI done? It has further refined the system. It has made the system much more efficient now. How? Instead of scanning and sending these particular checks in batches, now once you drop the check in the Punjab National Bank branch, now the check will be scanned and sent. Not in batches. Just like that, they will collect the check, scan it and send it. So the objective of Reserve Bank of India is, instead of clearing in batches, if you do it in let's say real time like this, the time consumption for clearing will be lesser. The settlement of the amount can happen much faster. That is the latest announcement by Reserve Bank of India, which has come into force from 4th October 2025. Now, I know some of you will be thinking, sir, what is the use of this particular system? We are using UPI today. We are using RTGS today. Then what is the use of this particular system? Isn't the check system obsolete now? Not necessarily. Please listen to me carefully. According to RBS data, in the last 3 years, utilization of the check, utilization in the sense the volume of the checks which have been issued and settled, no doubt utilization has gone down. But what is the value of the total amount that is transferred using the check? It has marginally changed. Marginally. It has come down by around 1 to 2%. That's it. So have a look at this. Despite having digital transfer tools now, even today, there is a prevalence of usage of the checks. Sir, where? The government departments. The government departments majorly even today issue checks. Even in the real estate, whenever the amount of transaction is very high, high value transaction, the checks are used. In rural India, where digital connectivity is much lesser, there is a dependence on the checks. So Reserve Bank of India simply says, no doubt, the UPI, RTGS, NEFT, etc. have boomed in India. Lot of transactions are being conducted using these digital technologies, but it has not made the check system obsolete. Even today, the check system is prevalent, is important. That's the reason this kind of a reform has been implemented by RBI now. Based on this, let's solve an MCQ. Consider the following statements regarding check truncation system. It was introduced by RBI in the year 2008. Yes, pilot in the year 2008. The banks and NBFCs are allowed to use the CTS. Incorrect. Why? Let me explain this. There is a system called as payment settlement system, where the amount, that is settlement of the amount, is done either using physical, let's say instruments, that is a check, or else you will also use digital instruments to settle the transaction. For example, RTGS, NEFT, etc. So these kind of systems are classified under the PSS Act of 2007, and RBI under this particular act has the power to basically say who is allowed to use these types of systems and who is barred from using these types of systems. NBFCs are not allowed to issue checks on their own name. Please remember, NBFCs are not allowed to issue the checks on their own name. Not at all allowed. So NBFCs are allowed to use the CTS? No, incorrect. Only banks. The system will help clear the checks 24/7. This is also incorrect. This is also incorrect. So first is correct, second and third is incorrect. Right option for the question will be option A. Only one of the statement is correct, by the way. Let me go forward. RBI launches draft ECB norms to ease overseas fundraising. If you remember, in the last session, I had a discussion regarding external commercial borrowing. What is an ECB? Under the ECB framework, the entities in India, that is the commercial entities which are operating in industries where FDI is allowed, these entities are allowed to borrow from external market, either in rupees or freely convertible currencies such as dollar. RBI mandates that right now, if you want to borrow under the ECB, under the automatic route, you can borrow annually a maximum of $750 million. And RBI also mandates what is the maximum rate of interest. I repeat, maximum rate of interest that you are supposed to pay when you borrow under the ECB. For example, if you're borrowing, let's say in foreign currencies, RBI has imposed a limit, a threshold, a maximum rate of interest that is based on LIBOR rate, London Interbank Offered Rate. And if you're borrowing in rupee terms, again there is one more rate of interest that is used as a threshold. The point here is very simple. Right now, RBI has a lot of regulations, restrictions, and RBI simply says this is hindering. This is making it difficult for the Indian companies to borrow easily from the foreign market. So now RBI has proposed certain drafts or changes. What are the important changes? Listen to me very carefully. Under the draft, companies now will be allowed to borrow not 750 million, rather $1 billion. $1 billion or up to 300% of the net worth of the companies. This is one very important change that has been announced in the draft. Second one, right now the minimum average maturity period, MAMP, minimum average maturity period is 3 years. RBI now says if you're a manufacturing entity and you want to borrow under the ECB route, I will relax it. You can borrow with a MAMP of 1 to 3 years. This kind of a relaxation will be provided. What about the interest rates? Like I said earlier, RBI used to decide what is the threshold interest rate you are allowed to pay. Threshold simply means the maximum rate of interest that you are allowed to pay. Beyond this rate of interest, you will not be allowed to pay by RBI. But now RBI simply says, let's liberalize this regulation as well. Rather than restricting to a maximum rate of interest, let's liberalize it. Whatever is the interest rate in the market, that is in the international market based on supply and demand, that will be the rate of interest that the companies will be allowed to pay under the ECB route. Right? These kind of norms have been proposed by Reserve Bank of India to make the whole system of ECB much more efficient, will allow the companies to borrow much more easily from the international market. So these are the changes which have been announced. Please make a note of these changes. Next article, the center is facing a challenge in sustaining the growers' interest in natural farming. Now, what is the issue here? Listen to me carefully. The government of India is worried about too much of consumption of inputs, external inputs in agriculture sector. What do you mean by external inputs in agriculture sector? For example, usage of chemical fertilizer, or else usage of chemical pesticide, etc. And in the context of chemical fertilizer, the problem is much more acute. Acute in the sense, the farmers majorly in India, out of all the different types of fertilizer, consume urea. Urea has the highest consumption in India. And because urea, we import a lot of it from the external market. Every now and then, there will be acute shortage of urea, black marketing of urea, unavailability of urea in different states, etc., which will hurt the production done by the farmers, supply in the market, which will create supply demand mismatches in the market. So the government of India has been implementing reforms. For example, there is an initiative called as National Mission on Natural Farming, NMNF, where government of India is basically promoting natural farming by providing certain incentives. But now government of India is facing a typical issue. Right? There is an issue. What is an issue? Under NMNF, the government provides an incentive of 4,000 rupees per acre for the farmers under this, but this will be provided for 2 years. Simple. It will be provided for 2 years. The farmers are facing an issue. What is the issue? They will get the incentives for 2 years. They are supposed to use certain naturally available inputs. After 2 years, they will not receive this kind of a, right, let's say incentive or assistance from the government. Now, farmers are basically saying we are not able to earn sufficient amount of revenues. We are not able to grow sufficient. Let's revert back from natural farming to traditional farming. This is one issue. And there is one more problem associated with this. The government has introduced a system called as PGS India. Please remember this. PGS India. What is PGS India? Participation Guaranteed System. Participation Guaranteed System. The Participation Guaranteed System essentially is a certification. There is a certificate that is issued to the farmers based on self-certification or self-declaration. The farmers will get this certificate, and now government simply says, because you have PGS India certification, it simply means you are following natural farming. And because you're following natural farming, the buyers in the market will be interested to purchase your product. You can get a premium price, higher price for your product in the market because you have not used any kind of chemical inputs. But the issue is one, the PGS India is not recognized globally. In fact, there is one more type of certification system in India. Please remember NPOP. Right? What is this NPOP? National Program for Organic Production. Right? Which is implemented by APEDA, which is being implemented by an authority by the name of APEDA, which is very well known authority in terms of promoting processed foods from India to the external market. This is internationally recognized in the sense there have been certain authorities which have been notified by APEDA. These follow international practices to provide certificate for these particular products. And because this is an internationally accepted norm, we are meeting the international standards, these kind of products which have this certification will be acceptable, will be able to fetch premium price in the market. But in case of this NMNF, the PGS India certification, it is not recognized in the global market. Consumers in India do not understand this and they're not willing to pay the premium price for the products cultivated by the farmers following natural farming. So, as a result of all of these particular issues, the farmers are finding it very difficult to sell the crops. Incentives are stopped, and now the farmers are feeling burdened. They want to basically go back to the traditional system, which is hurting the initiative or the objective of government of India to reduce the consumption of chemical inputs and to promote the natural farming in India. So these are certain very important points. Please make a note of this. Next article, the last article for today's discussion, the basic savings bank deposit account. Now, what is the idea of a basic savings bank deposit account? I'll start using the short form BSBD. All of you heard of Pradhan Mantri Jan Dhan Yojana. What are the essential features of Pradhan Mantri Jan Dhan Yojana? You do not require to maintain any kind of a balance. That is, you can have zero balance in your bank account. Once you open a bank account under PMJDY, you will also get a debit card. You will be given a checkbook, etc. Now, please understand these services which are applicable to the PMJDY accounts. These are essentially the accounts which are called as Basic Savings Bank Deposit Account, BSBDA. What is the importance of promotion of BSBDA, which is being done by Reserve Bank of India now? RBI simply says these are essentially types of accounts which will not put a larger burden on the bank customer. Customer doesn't have to follow, right, or doesn't have to keep any kind of a balance. Customer is issued with mobile banking service. Customer is issued with internet banking service. Customer will get a debit card, can deposit money, right, in the bank account, can withdraw money using the ATM, etc. So these are the types of basic services which every customer requires. And if the bank imposes a restriction, imposes charges, it will hurt a lot of these bank depositors. Now RBI simply says every bank has to provide basic savings bank deposit account as a standard service. This will promote utilization as well as usage of these kind of bank deposit accounts, especially for middle income households as well as lower income households. And by the way, the bank accounts which are opened under PMJDY are a type of basic savings bank deposit accounts. Done? So these are certain very important points associated with different articles, concepts associated with the different articles, as well as questions related to different articles that we have covered today. If you're liking this initiative, do recommend this to others as well. Do not forget to hit the like button. And if you're yet to join our YouTube channel, kindly do it right now. And those who are wondering, sir, how can I get the PDF of this? How can I get the notes of the topics that you have covered in today's session? Please go to the description section of the video. There will be a link by the name Indian Economy Repository link. Please click on the link. You will get access to a page. In that particular page, all the PPTs as well as the notes links have been provided. Get the link, download the PDFs. More importantly, use the PDFs for revision. See you next time again with set of articles from the Indian economic current affairs. Till then, take care.